Looks like we are not done with the banking crisis yet. This Monday morning, regulators seized the First Republic Bank, a mid-sized bank located in San Francisco, making it the second largest banking failure in the US history, and the fourth bank to fail since March this year. First Republic Bank was bleeding since the collapse of Silicon Valley Bank and Signature Bank, and 11 US banks injected $30 billion to save it. But it was not enough. So this time, regulators had to come and make some tough decisions. All the assets and deposits of First Republic Bank have been sold to JPMorgan Chase in a bid over the weekend. JPMorgan Chase has acquired First Republic's $92 billion in deposits, both insured and uninsured, along with most of the bank's assets of $203 billion, which includes $173 billion in loans and $30 billion in securities. First Republic Bank's 84 branches in the country opened on Monday morning as the branches of JPMorgan Chase. But the shareholders are completely wiped out in this deal. After this deal on Monday, JPMorgan Chase CEO Jamie Dimon said, "This part of the crisis is over. Everyone should just take a deep breath." But is it? We don't know yet. Though, unlike Silicon Valley Bank, the situation was more controlled this time. But it has definitely triggered another round of uncertainty in the US banking system. Many are speculating whether the crisis is over or it will get worse. Few other banks like PacWest, First Horizon, Western Alliance, Comerica, and Zions Bancorp saw a significant drop in the share prices this week. In today's video, we will see what happened with First Republic Bank, how a bank of this size who was handling the most affluent clients failed, what this deal means for JP Morgan, and finally we will see what this collapse means for the market and if the crisis is over or not. So if you are interested to know more about this second largest banking failure in the history of US, then stick around. First Republic Bank was a commercial bank headquartered in San Francisco, California. Founded in 1985 by James Herbert, First Republic opened with one branch and less than 10 employees. Its IPO was launched in 1986. In 2007, bank was acquired by Merrill Lynch for $1.8 billion. But during the financial crisis of 2008, Merrill Lynch was acquired by Bank of America. Bank of America then sold First Republic to a set of private investors, including its co-founder James Herbert, for $1 billion. It was one of the only bank sales in 2009 that didn't require assistance from FDIC. In December 2008, James Herbert took the bank public once again. By July 2020, it was the 14th largest bank in US, with 80 offices in 7 American states, $229 billion of assets, and a staff of more than 7,200 people. You'll be surprised to know that First Republic Bank has been profitable every year since its founding, and was one of the top choices for the high net worth clients. In February 2016, Private Asset Management magazine announced First Republic as the best private wealth manager for the 6th consecutive year. Until 3 months back, James Herbert, co-founder of First Republic, was one of the most admired US bankers, who had grown First Republic from just 9 employees to America's 14th largest bank by offering world-class services to its affluent clients in private banking. Now, almost everything has turned into dust. In November 2021, one share of First Republic was trading at $220, and on April 28, 2023, the day when FDIC took control of the bank, one share was $3.5. That's a fall of almost 99% in just 1.5 years. But still, the question is that what happened in the last 3 months that caused the collapse of such a strong bank? And was the situation so bad that it could not be avoided? Well, there's a lot more in this story. But before uncovering more on this topic, if you have enjoyed the video so far, please smash on the like button. It helps the YouTube algorithm. And if you're interested to know more about these kind of topics, then please subscribe to our channel and click on the bell notification so that you never miss a new video from us. Thank you. Now you must be thinking that First Republic Bank had a lucrative customer base. Dealing with high net worth clients means money, and these clients would rarely default on their loans. Also, the bank was not dealing with any venture capital clients like Silicon Valley Bank, nor involved in crypto like Signature Bank. So what was the issue? So though the businesses were different, the market conditions were the same for all the collapses. The first similarity between the First Republic Bank and Silicon Valley Bank is that both had high number of uninsured depositors. At the end of 2022, First Republic had $176.4 billion in deposits, and 67.7% of these deposits exceeded the FDIC's 250k insurance limit. And the second similarity is that First Republic has also put most of its deposits in the long-term assets, though it was not treasuries like Silicon Valley Bank, but fixed-rate mortgages, which won't mature for years. First Republic Bank's primary business was to lend out fixed-rate mortgages for single-family properties. The bank didn't expand its business to other products like auto loans or credit cards to balance out the risk. They had 81.3% of outstanding loans with maturity of 5+ years and 62.4% loans with maturity of 15+ years. In 2022, more than half of its loans had an average interest rate of 2.89%. So the rising interest rates became a big concern for them, as they had $22 billion losses on paper. And in the case of First Republic, they invited this problem on their own. In the last few years, they offered almost free mortgages to the wealthy people. For example, they set up a branch inside Facebook's headquarters and offered employees mortgages at an average of 2.5% interest rate. And you know one of their wealthiest clients? Mark Zuckerberg. In 2012, First Republic gave $5.95 million of mortgage to the CEO of Meta for just 1.05% interest rate, which is almost free money. So on one side, the bank had its deposits seized in long-term mortgages, which were reporting losses, as interest rates have been increased multiple times since 2022. On the other side, after the March banking crisis, people were moving their assets. Now, unlike Silicon Valley Bank, First Republic was not able to sell the long-term assets. Selling the treasury bonds was easy, but First Republic can't get the mortgages back. So First Republic used Fed's PTFP program to lend money against its long-term assets. But bank withdrawals kept on increasing since March, and Fed was left with no other option but to intervene and shut down the bank. While many banks try to get high net worth clients to grow their deposits, the business model of catering to the rich became a liability for First Republic Bank. When a bank is in crisis, everyone gets worried and wants their money back. And when so many wealthy clients come to get back their deposits, nothing can save the bank. No bank keeps all their deposits in the bank. In fact, they only keep a small percentage of the money in case the customer needs to withdraw it, and the rest of the money is invested in long-term and short-term assets. After getting help from Fed's PTFP program and $30 billion from other banks, First Republic was trying to save itself from the crisis. Now, 2 weeks back, First Republic released its first quarter earnings that revealed the $100 billion of deposits were withdrawn after mid-March. After the earnings call, its executives took no questions from the analyst. These were few red signals, and next day, First Republic's stock dropped by more than 50%. And by last Friday, First Republic was in FDIC receivership, and other banks were asked to submit the bid proposals. And after working over the last weekend, the largest bank in US, JPMC, won the bid to buy First Republic Bank. This is not the first time JPMC has acquired the failed banks. During the 2008 financial crisis, JPMC acquired both Bear Stearns and Washington Mutual. In this deal, JPMC will be paying $10.6 billion to FDIC to acquire First Republic without any corporate debt or preferred stock. FDIC will reimburse JPMC most of the losses on the acquired loans. FDIC will also provide fixed-rate financing for $50 billion in the next 5 years. So overall, First Republic will cost around $13 billion to FDIC, and it's huge. This deal is already facing criticism over the handling of First Republic, and there are two main reasons for this. First, the new buyer JPMC, and another, First Republic Bank's executives. So let's talk about JPMC first. According to a law, no bank can have more than 10% of the market share of deposits in US, and with more than $3 trillion in assets, JPMC is too big to acquire First Republic. So now it raises questions on the regulators on how they allowed JPMC, the biggest bank in the country, to get bigger. When the big banks are getting more strong, it creates a monopoly and it becomes hard for small and medium-sized banks to do business. Now, another reason for the criticism is the short selling of stocks from insiders in the First Republic Bank. In mid-March, the Wall Street Journal reported that James Herbert, First Republic's founder and executive chairman, sold $4.5 million worth of shares since the beginning of the year. Also, other executives like Chief Executive Roffler, Private Wealth Management President Thornton, and Chief Credit Officer Litzman sold a combined $10 million worth of shares in the last 5 months. On one side, First Republic claimed that they are selling unprofitable assets, laying off 25% of its staff, cutting dividends, and vesting of performance-based incentives. Even Herbert himself would waive his salary for the year. But how about the selling of $15 million worth of stock? Why there are no questions raised on this? After JPMC took over First Republic, depositors' accounts are good, but investors have lost their money, and these executive selling of stocks in the last 5 months had a big contribution in the investors' losses. Now, after the fourth US bank collapse within a few weeks only, the main question we all have is the crisis over? Although it's hard to say, but many people are blaming the Fed for the loose monetary policies for many years, along with the faster interest rate hike, almost 5% in the last 14 months. While no one can predict what will happen in the future, but few small and mid-sized banks are impacted already. In just 1 week after the collapse of First Republic Bank, shares of PacWest dropped by 45%. Tennessee-based bank First Horizon's shares were dropped by 34%. Western Alliance dropped by 30%, and Comerica and Zions Bancorp dropped by 11%. Also, there is uncertainty in the economy, and inflation is still high. Fed economists have warned about a mild recession later this year. This week, the Fed has increased the interest rates by 0.25% again. But the good part is that the regulators are taking these failures seriously. There is a 114-page report which will set some rules for the future. It will tighten rules that were eased by the Fed lately. There is also a proposal to revise the FDIC deposit insurance coverage to avoid future bank runs and promote financial stability. And we are definitely looking forward to these reforms. So, that's about the end of another bank and the second largest banking failure in the history of US. Let us know what you think about the First Republic downfall. Also, let us know what you think. Are we done with the banking crisis now? Let us know in the comments below. If you've enjoyed this video, please do like it. If you are new here, please subscribe to the channel and help us grow. We are trying to bring more amazing business stories to you. Also, let us know what other business stories you would like to see. With that said, I shall catch you in the next one. Thank you and have a nice day.